2027. Bank of America just said rate cuts won't arrive until the second half of 2027. And if you're still positioned for a dovish Fed pivot, your portfolio is built on a foundation that's cracking right now. Here's what's really going on, and what you should be thinking about right now. Trump picked Kevin Warsh as his preferred Fed nominee. The play was simple. Get a friendly face in the chair. Push rates down. Juice the economy. Straightforward political calculus. Except bond markets aren't buying it. Right now, Treasury yields are pricing in a scenario where Warsh doesn't cut. He hikes. That's not a fringe view. Fed Governor Christopher Waller, a current voting member, publicly stated he will not rule out future rate increases. Not a maybe, not a hedge, a flat refusal to take hikes off the table. And then Bank of America drops the hammer. No rate cuts until the second half of 2027. That's 18 plus months of high rate pressure. Minimum. Baked into their base case. Core inflation is still running hot. The Fed's 2% target remains out of reach. Every month that number stays elevated, the case for cuts gets weaker. And the case for hikes gets stronger. You're not waiting for a pivot anymore. You may be waiting for the exact opposite. But here's what nobody is saying about this yet. Trump wanted Warsh because he expected rate cuts. The political logic assumed a compliant Fed chair. What markets are now pricing in is that Warsh may actually be more hawkish than the current committee. The setup completely backfired. Retail investors positioned for a rate cut rally in growth stocks, REITs, and long-duration bonds just got handed a 2027 timeline from one of the biggest banks on Wall Street. That's not a delay. That's a regime change. First, stress test your rate-sensitive positions right now. Growth stocks with high price-to-earnings multiples and zero near-term earnings get destroyed in a prolonged high-rate environment. Know your exposure before the market reprices it for you. Second, re-examine any real estate or REIT allocation. Cap rates and mortgage costs stay elevated if the Fed holds or hikes. Cash flow assumptions built on 2024 rate cut expectations are now structurally wrong. Third, look at short-duration fixed income over long-duration bonds. If rates rise further, long-duration instruments take the biggest hit. Short-duration treasuries and money market instruments let you capture yield without the price risk. Kevin Warsh walks into the Fed chair role and raises rates before 2026. That's the scenario bond markets are quietly pricing in right now. Agree or disagree? Drop it below. And if this changes how you're thinking about your allocation, share this with someone who's still betting on cuts. This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.